On today's show, 3 questions. Number 1, who won the government shutdown? Number 2, did someone say 50-year mortgage? And number 3, is it time to start collecting pennies? Let's go.
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Sean.
And I'm Rabih.
Yeah, you are. And welcome, Sean, to the show. This is awesome. First time.
Yes,
Welcome.
Thank you. Long-time listener, first-time participant. So happy to be here.
This is for those of you that don't know. Sean is one of the newest members of our team. But Sean, how long have you been here now? It feels like a long time in a good way.
Yeah, since March. So I guess that puts us 8 months.
Wow. Yeah, it just feels like everyone that's joined our team lately. Again, it's in a good way where I'm kind of like, it just feels like you've been here forever, and we're just kind of all like in the groove. So Sean is is our newest advisor. So you'll get to know him and love him as we kick this off today and beyond. So excited to have you, Sean. And Rabih, hello. Good to see you too.
Hey, what's up? No, I love that Sean is joining us. People who are listening do not know this, but Sean is like one of the nicest people ever. You can make so many mistakes and he'll treat you as if you made an accomplishment. So I love working with Sean.
Hey, let's just make this episode about Sean and everything we love about Sean. No, we're excited to have you here and talk about all these topics here, some big things. But Rabih, number 1, let's get real spicy. Who won the government shutdown?
Yeah. And by the way, congratulations, Matt. You ended the shutdown.
We finally did. It took us a little bit of effort, more effort than when we break strikes. But it took me a few more text messages and Facebook messages. I had to send the right people. They finally listened.
Did you have to go into caps lock so they can?
Exactly. I had to go all caps. And ChatGPT was working extra hard for me today.
Well, they actually heard I was going to be on 2 cents. So they're like, we got to make sure we've got some topics. Okay. Yeah. So let's end this thing.
Exactly. So yeah, glad it's finally over.
So who won the government shutdown? If you're expecting me to start, naming politicians, you're wrong. I'm going to name asset classes. This is where we're going with this.
We just like getting all sensationalistic with our headlines and getting all people are like, wait, what, are they going to get political? No, we are not.
I honestly, one day I'd like us to send out a survey for people to predict my political leaning and your political leaning and see how off people are. Like, I think we do a good job throwing them off.
I think so.
Okay. So with the government, shut and then open again, I've prepared 2 things for you today. 1, we're going to survey through the performance of different asset classes and what that tells us. And 2, I think the more important part is, when do we expect the data to come back? Matt, I need the data, right?
You need that new car smell.
So actually, let me start with the data. So we've got 3 main sources of data. And although the government is opening, it'll be some time until they start posting the data again. So the first source is usually the Bureau of Labor Statistics, and that is where we get the jobs number, like the unemployment rate, the total farm payroll, non-farm payroll. This is where we get the CPI, which is the inflation, and stuff like that.
And that's when they're scared to deliver they're probably actually pretty happy right now that they haven't been able to release data, because no one's at risk of being fired.
Yes. And actually, I started with the Bureau of Labor Statistics because it was the one that caught my attention. They had a press release. Also, the White House announced, and they were saying, hey, this is the White House media saying that October jobs data may be never released because no surveys were conducted while the Bureau of Labor Statistics were furloughed. So usually after the government opens, all this data, and we had it closed from October 1st to like November 10th or 12th, right? This is the period. And usually in October, they should be sending out the surveys, reaching out to companies, reaching out to, people who filed unemployment, etc., and estimate how many people exited the workforce or how many people entered the workforce. And based on that, they would calculate the unemployment rate, etc. Given that people were furloughed, usually they keep doing them in the background. I do not know why they got furloughed. So we might have a scenario where we're going to get the September data now, 2 months late, and then we'll have a gap for October, and we will not get data until end of December, where we get the November data point. that will make it harder. And actually, I was looking at the Fed funds rate futures, which tell us what the market expects interest rates are going to be in December, and kind of tells us the probability of a cut versus no cut. And given this news about the interruption in the data, now it's adjusting back. But as of yesterday, we had a 50-50 chance of no cuts versus a cut in December, according to market expectations. We moved from a 90% cut probability to a 50-50%. So the market participants are like, yeah, maybe the factors are coming in the Fed's side, where there is fog, according to their analogy, and they want to slow down because there is fog. And until we start getting proper data, the fog will not clear away. And with now the data not coming up, even more fog.
So that's just a result of uncertainty. You're saying the 50 they get dropping. That's a drastic drop.
Yeah,
but it's more just because we just don't have the data, so it leads to more uncertainty and less.
Exactly.
Less
Actually,
precision.
A probability split of 50-50, it means that you do not know anything at all.
Yeah.
If you go to 60 or to 70 or to 80, it means that you are more certain about a certain outcome. The point of most, confusion is a 50-50 split. So this is where we are. The next source is the Bureau of Economic Analysis. This is where we get the GDP data, the PCE, income and spending. This is not as important as the Bureau of Labor Statistics, mainly because GDP data is coming in quarterly, not weekly or monthly, right? And the last one we're going to be getting is the Census Bureau, which tells us about retail sales, the strength of the U.S. consumer, the housing market, and prices and spending on durable goods versus non-durable goods, which tells us how it's more about the census. It's more about the consumers and what their health is and what they're spending on, and it's kind of the driver of economic activity. You can use that to predict the GDP. So these are all the data points. We're talking about like 10 reports that stopped coming in that we need. Probably the only one that was still running while the government was shut down was like the consumer confidence, because it's done by the University of Michigan, etc. But that is coming back, and I said it probably 3 times previously on this podcast. When this data starts coming in, the market has to calibrate to a new information, and that might be noise. Don't freak out when it happens, whether it's going to be positive or negative. We're just trying to catch up information-wise and having the prices reflect that information, which is a hint to the next segment, which talks about how prices moved from the beginning of the shutdown until the end of the shutdown. Any bets on who did really well?
Look at you just segueing yourself. Like, it's like you've been doing this for years, and you're just
I've been doing this for over 2 years now.
I know. You're just a professional. I can tell you who didn't win the shutdown, which was anyone who was traveling over the last few weeks. Ugh. Holy cow. I think that's so I don't know the winners, but I definitely know the losers, which was anyone who was needing to travel. And I'm hoping they clear all this up before the Thanksgiving holiday, because I'm sure that would just be extra nightmare. But have no guesses of who won. Tell us who won, Rabih.
Sean, any guesses?
Oh, I wouldn't be as confident on winners either. I would say as far as losers. So I was in DC a few weeks ago for a dental conference, and we ran into some tourists from France who were really excited to go to the Smithsonian museums in DC and weren't able to because of the shutdown. So I would say, unfortunately, the tourists, not just for air travel, but also those trying to go to the monuments, were unfortunately losers.
Well, so we have a negative tilt today on Friday. Yeah. Sean and I are just calling out all the losers, but we're like, who are the winners? I have no idea.
Actually, I think the losers are crypto. Bitcoin, since the opening of the government shutdown, closing of the government shutdown until now, it's down 14.36%, right? I would say crypto has been the main loser, which is surprising because
that is surprising
against the narrative of what.
Okay, Bitcoin I'll call out who won. All members of Congress who got basically a paid vacation because they all somehow, shockingly, how this works. I don't know how this happens, but they all somehow still get paid during a government shutdown. Riddle me that.
Yeah, actually, government officials got paid, and the only people who I think are made some money from the shutdown, I read it as an article. I'm not sure my sources are credible here, but some TSA employees are getting a 10K bonus because
I saw something about that too.
So probably these are the only
they
two
stayed,
winners.
You're saying?
Yeah, they stayed. So And you would want the TSA to stay, right?
Yeah. Yeah.
Okay. So yeah, Thanksgiving's coming up, Christmas coming up. It's a lot. I would say the biggest performer was gold, but not as much as we think it was. For that month and a half period type of deal, gold is up 7.71%. But the volatility throughout the whole period is significant. Gold had a drop of probably at negative 10% from its high to the low. So it started at 0, went all the way up to like 15, 16, and then dropped 10%. And now we're at the 7% return over that period. So there was volatility in gold. And it's simply because back in like, give it a couple of weeks, we did not know how long that will last. And people were trying to hedge their position into gold. Anything else, not to spoil the surprise for you, anything else stayed flat. We've got emerging and developed, which are not like really affected by the US government shutdowns, closed at 2% up or 3% up for the month and a half. But if you start looking at many indicators of the US market, whether it was the S&P 500, flat 0.75 for the period, Russell 3000, 0.5, 0.45 for the period. Small caps are negative 2% for the period. Nothing happened. Like the movements are not there. Although the inter-period fluctuations were severe. We're talking about from like the Russell 2000 or the S&P 500, etc., had swings in between the periods. And if you choose the largest price it got to and the lowest price it got to in only these 40 days, you are seeing 6 and 7% swings. But once you look at it by the time the government opens, which is information input into our formula, we went back to where we started. This was the narrative with equities. And then the narrative with fixed income, the same, exactly the same. We started with a 10-year treasury at 4.11%, and we are at 4.11, 4.13%.
But did that have a bounce during as well, or no?
A balance, like
did that have a bounce? Did that fluctuate?
No, it was flat. It was flat.
Pretty much stayed flat.
And I think the fact that you can compare equities fluctuations to fixed income fluctuation means that the equity fluctuation was not coming from government related stuff. Yeah. And it was coming from the tech AI bubble, not bubble. We covered it, whether it was Plantier and Michael Berry, or whether it was, how they are funding each other and markets readjusting. All of that was fueling the narrative and creating some turbulence in equity markets.
Side note, Rabih, I told Jake this yesterday, but after we talked about The Big Short and Michael Berry and all that stuff on 2 Cents, I went back that weekend and I watched The Big Short again.
Okay.
Just so good. It's a
really good movie.
And just like a movie that you finish, and the rest of the weekend I was just like, what is like it just kind of makes you think the entire, for days afterwards about what else is brewing or happening. You know what I mean? It just makes you, and how it all went down. It's just crazy. So if you have not watched it or read Michael Lewis's book, highly recommend.
I think something that is interesting that happened across the time, fixed income did not move. The yield curve structure, is it steepening, is it inverting, etc., did not move. But something that was found interesting is that the US dollar across the board versus all currencies, whether it was European, the euro, the British pound, Japanese yen, Chinese yuan, Australian, New Zealand and Canadian dollars, Swiss francs, Norwegian francs, whatever, you name it, the US dollar appreciated against them, which I think if you want to try to work really hard to extract information, this fits into the narrative that the current administration's work of a weaker dollar, bring in back manufacturing, trying to change the trend that was happening pre this administration coming into the office, diminishing dollar, raising the return for foreign investments from the perspective of a US investor. That went on a pause, and market forces took over again for that period of a month and a half. We alleviated the pressure that we were doing as an administration to sway global markets in our, in our direction. The dollar appreciated, but I wouldn't say by large magnitudes. We're talking between a 1% and a 4% move. It's not like the currency moves, but takes much longer to move. unless there's a crisis. So it is interesting to, if you want to think of it as an experiment, we got a 1 week and a half experiment, a 1 month and a half experiment, where if we remove our intervention into the markets, what are the driving forces and to which equilibrium are we heading? And the equilibrium says stronger US dollar, more money flowing out of the US, the same narrative that we've had, which increases debt. So I would say the one last thing on this, if whatever the government is trying to do, whether it's correct or not economically, this is a different conversation, but whatever they do was stopped, the markets will revert back. It's not that they have a permanent impact on what happened to the markets, which falls into the idea it's like no single administration determines the fate of markets, no single event determines the fate of markets, etc. Once you remove your intervention, it could revert back to the actual systematic forces, and those are very hard to steer.
So at the end of the day, really no winners or losers, just kind of business as usual.
Yeah, we just got some headache for a month and a half, but that did not change anything economically. And now with new data being released, right? We talked about that, and with a Federal Reserve meeting in December, and they said they're going to announce the new Fed chair by Christmas. All of these are going to be actually market-moving information rather than what we experienced for the last month and a half.
Yeah, and I guess we'd be remiss if we did not emphasize that we are not approaching this topic too flippant or cavalier in the sense of there were actual real losers in the sense of families, people who were impacted, not only like TSA members, like we're saying, but we all know like SNAP benefits and things like that were impacted. So we do want to make sure that we are emphasizing, Rabih, to your point of not getting political, towing that line. But anyway, I do want to emphasize that this was actually quite stressful for a lot of people and families, and we are very happy that that we're back up and running. So, Sean, anything you want to add to this on the government shutdown topic?
Yeah, I just think it's interesting to see that there were some swings in the market. Overall, after all was said and done, there weren't significant changes. I think that's always interesting to think about, and we can't get too high with the highs, too low with the lows, and you just kind of got to wait it out and let it ride.
It's so true, and it's interesting to think of the impact. It's probably not long enough it wasn't a long enough period of time to really understand like the impact of information on the market. But you're like Rabih, we're seeing some swings obviously in equities, but flatlining in the fixed income market, which doesn't really surprise me because I'd say the fixed income market relies probably more heavily on that intrinsic data, and equity markets is a lot of other factors that impact it.
It's noise versus signal, right?
Yeah.
And there was no signal, literally no signal for a month and a half. It was all noise.
Yeah, which is why you were seeing equities move, but fixed income kind of just like take a breather, basically.
Yep.
That makes sense. Okay, on to the next. I don't think this shocks anybody that we are going to talk about this one. The most viral news if you can say financial topics go viral, which they go viral for us internally, but not really out in the real world. But this one I think did. And the question is, did someone say 50-year mortgage?
What?
Yeah, what? I've never heard of this. Sean, break it down for us.
Yes. So not only did someone say 50-year mortgage, but the president of the United States, Donald Trump, happened to say that and did so in a very interesting way of stating great American presidents, an image of FDR, who was pivotal in introducing the 30-year mortgage back in the 1930s as part of the New Deal, alongside a picture of Trump with 50-year mortgage underneath it. So kind of teasing that idea that, hey, there's potential for change coming. And really, from what I've gathered, the overall hopeful takeaway from this is that home prices being at all-time highs, interest rates being high, it's just very difficult for people to afford homes. And so the overall goal is, can we make homes more affordable by allowing a 50-year mortgage? And so it's definitely interesting thought. Definitely ran some numbers to learn a little bit more about what this would look like. And with some recent news where the average age of a first-time homebuyer just hit 40 years old, I do think it does make sense to try to figure out, hey, how can we make housing more affordable? But I'm yet to be sold on a 50-year mortgage being the answer to that, and definitely have some data that I think will bring this into a little bit better discussion. But what like initial thoughts, questions, I guess came to your mind as you have been processing the idea of a 50-year mortgage?
Yeah, I'm with you. I think I would say the intention is good overall. I do think the intention is probably whether it be like a political win type of intention or like a true intention. I'm not here to speak on that, but I would say the intention is a good one, to your point, Sean, in saying we need to solve this problem of making housing more affordable. So on the surface, I think when you initially hear that, you're like, oh yeah, extend the mortgage. Naturally, you're thinking the payment's going to drop. Okay, that could make it more of a reasonable approach. But I know we're going to get deeper into this, is like the numbers don't actually bear out. And also, I think the second order effects, if you go deeper on this, let's imagine for a moment that it actually did make it more affordable, or the barrier to entry was lower to get into the home. Well, until we solve the issue of shortage of single family homes in America, this is going to do nothing except probably exacerbate the issue once you get to the next level. So those are my initial thoughts, but let's go to Rabih.
Yeah, 100%. I agree with you, Matt, because lowering the mortgage payment just because you're extending the term of the loan affects the demand side of the equation. But the problem is supply.
Yep.
So really, it's a good policy to, increase demand for the housing market. But is this the right policy for this problem that we are facing, right? I don't know if Sean has the later data, so I don't want to jump on your content, but I just want to throw this in just to be a little spicy, Matt.
Yes.
Remember,
Yes.
We always have this argument of rent versus buy, and at a 30-year mortgage, there's always this argument that you'll build in equity in your home if you buy instead of rent. Now with a 50-year mortgage, it's very hard to build in equity. Does this tip over the scale for the renters? This is what
That's a good question. Yeah. And we're going to get into that. Sean, I know you're going to break the numbers down. So that's a really good question to have in the background.
Yeah, absolutely. So I ran some numbers. Some of these are obviously assumptions because we don't know exactly what a 50-year mortgage would look like from an interest rate standpoint. But based on some of the historical data that we have, I think it's probably safe to assume that we would see a little bit of a higher rate on a 50-year as opposed to a 30-year. So just for being conservative, I did give it a 0.25%, so 0.25% bump. So I ran a $500,000 example. So a $500,000 loan, 6% for a 30-year, which is right around what we're seeing, maybe even a little generous there, opposed to a 6.25% 50-year mortgage. So comparing the payments is looking at it to try to say, all right, how much less would a payment be on a 50-year as opposed to a 30-year? And was a little surprised to see it would only be $273 less a month. So yes, that can go a long way for some people, but what's the trade-off to the $273 less payment? So as we see that, if we were to say, all right, the 50-year mortgage after 30 years, when a 30-year would be paid off, what would the balance still be? Just so we can compare that. And in this situation, there would still be a balance of $372,000 after 30 years on a 50-year mortgage. So there would still be it's right around 75% of the original loan amount owed after 30 years of making payments on a 50-year mortgage. So that just shows that it's really not a great way to build equity. And then as we're jumping into, okay, well, if that's the case, how much interest are we paying over the long term here, the full loan term? What would that look like? If we were to compare the 30-year, the total interest paid would be $579,000. And it would be just over $1.1 million on the 50-year as opposed to the $579,000 on the 30-year. So essentially, you're getting close to doubling the amount of interest that you're paying on a
$500,000 more in interest.
Yeah.
Yep.
Absolutely wild. And for me, it's also interesting to see, okay, how long, if you're on a 50-year payment, how long does it take for your monthly payment to have more going towards principal than interest? And that'd be 39 years. So for 39 years, the majority of your payments going to interest, and it's not until literally right when you hit year 39 that you'd start actually paying more a month towards principal than interest. So those were just some numbers that I thought were really insightful and a little scary at the same time.
For sure. Can I take this just a little farther, Sean?
Yes,
too?
please do.
Let's say you equalized it. Let's say you got the same interest.
Yeah.
Let's say the government said, you know what, same thing, $500,000 loan. Let's just say 6% either way.
Yep.
You have the choice. Even that difference on a $500,000 loan is only on payment $366 per month. So again, to your point, for a lot of people out there, that's a difference for sure on a monthly basis. That might be the difference of like your car payment as well. Yeah. So it can definitely make a meaningful difference. We're not downplaying that, but and even in this scenario of equalizing the interest rate, you're still paying $500,000 more in interest. And just really quick, for just a refresher for those of you on mortgages, there's an amortization schedule, and you pay all of your interest pretty much up front in the first half of that loan. Or to your point, Sean, for 39 years of that loan plus. So when you're paying a 30-year, on the first payments, 83% of your payment is going towards interest on the front end of a 30-year mortgage. This is why we talk about if you're not going to live in a home for longer than 7 to 10 years, you might as well just rent because you are anyway. On a 50-year, your initial payments, 95% are going towards interest. It becomes basically interest only. You're accruing no equity, to your point, Sean. So I have a hard time seeing this being an answer for anybody when you really break the numbers down. Rabih, do you have any additional thoughts on that?
I do, and I'm chat GPTing it as you guys speak.
Yeah, you are.
I'm trying to. I didn't finish typing. You caught me off guard.
Oh, sorry.
What I'm trying to ask chat GPT, because I haven't run the numbers yet. There's this scenario where you have a 30-year mortgage, right? And they tell you, and this is related to the question of how much of your payment is going towards the loan versus the principal. And this is more of those proponents of like pay your debt as quickly as you can, and you will shave off so many years and a lot of interest off your loan. So when you pay a little bit more over your payment in a 30-year loan, it has a significant improvement in the amount of interest you end up paying and the time of that mortgage until you fully own the home. If you were in a 50-year mortgage instead and you do the same strategy, is the benefit received higher or lower than a 30? I'm trying to understand the relationship. If you extend the loan duration, does a prepayment put you at a better position? Like, can you change this 50-year, dilemma that you have into something that gives you even better profits up front? I still didn't run the numbers, but you guys can think about it while I continue typing. And
Okay,
we'll see what it says.
keep running the numbers. Sean, anything else you want to add to this?
Yeah, I think just one comparison that we have is we've seen over the years how auto loan terms have been extended out, where you can. It used to be probably more.
Now.
It used to be
4 months.
More standard to say like 4 or 5 years, and now you're up to 7 years. And what we've seen as a result of that is people just buying a more expensive car. We haven't seen it be, it's more affordable. I'm able to also pay my other bills. We've just seen, us consumers, we love to buy the next greatest, best, biggest thing we possibly can. We've just seen that result in buying nicer, bigger, more expensive cars, paying more interest in the long run. And also as a result, there are other factors, but we've also seen that car prices are continuing to climb. So it's just kind of an interesting comparison, though we're talking about a home versus a car, but that's kind of a recent example where we've seen loan terms extended.
Really good example, Sean, and it leads into it kind of is like the underpinning of the American economy, as we all know, is consumerism. And the car loan, I think most people go into cars just thinking, does this fit into my payment? Does this fit into my monthly? Can I afford the payment, without thinking about what does this actually mean for my overall financial situation, is how much interest I'm going to pay. So like, for example, on the house side, the average American tenure in a home is 10 to 12 years. That's actually higher than I thought, to be honest, that the average homeowner owns their home for 10 to 12 years. So again, just like your car example, Sean, I know people who buy who maybe buy a car, put it on a 7-year and sell it after year 3. Same thing with this. If you're going to put a home on a 50-year mortgage and then you're going to sell it in 9 years, you might as well have just rented the home. And so it's a really good point, though. Rabih, did you finish your analysis?
I got the data.
Tell us.
And
hit us.
Don't kill the messenger, but no. If you overpay on a 30-year mortgage, you save more money than if you overpay on a 50-year mortgage. Here are the numbers. So we're starting with a $500K loan, just as Sean was saying. The interest rate is 6%, and we're comparing a 30-year loan versus a 50-year loan. And what we are doing is that for the payment, we are increasing an additional $200 per month towards the principal. So in a 30-year mortgage, you would pay $2,998, but with an extra $200, you're paying like $3,198. The loan payoff drops from 360 months to 300 months. It means you're shaving off 60 months. That's 5 years off your mortgage. So you'll own your house in 25 years instead of 30 years. And you save between 120K to 140K of interest. That is the 30-year loan, right? If we do the same math on a 50-year mortgage, your payment here, instead of it being $2,998, it's $2,514. And with an extra $200 on it, you are paying $2,714. Your loan payoff drops from 600 months to 540, 550 months. So you only shave 45 up to 60 months. Between 3.5 years up to a 5-year shaving off your mortgage. But remember, shaving off 5 years out of a 30-year mortgage is completely different than shaving 5 years off of a 50-year mortgage. You have to look at them in proportion. And in interest saved, you'll only be saving between 80K to 100K by doing that extra $200 payment, which is much less than the 120 to 140. So no matter how you're looking at it, the 50 is going too far in the other direction, and you can't really find any benefits out of it. What do you guys think?
I'm with you. I mean, that doesn't shock me. I'm also running some back of the napkin calculations really quick. We're trying to make a case for this, guys. We're going for it. Okay, let me tell you what go ahead, Sean.
I was just going to say why you're running those, Matt. I think as I was thinking about this, like, who would this make sense for? And I know I think it's actually going to be pretty popular because we are in the mindset of like, how much down, how much a month. I want the least amount possible, not thinking of long-term consequences or savings or interest. So I do think this is, assuming it goes through and passes all the necessary steps, I do think it will appeal to a lot of people because it is less on a monthly standpoint. So I was just trying to think, like, who would it make sense for? It could be somebody who just does want to live in a house for a certain period of time, wants to be a homeowner, doesn't really care about equity, and wants to lock in like a fixed rent payment. But I guess the argument there is, being a homeowner, things break all the time. It's not just one thing. It's usually 3 or 4 things at the same time, especially if you have kids that are breaking stuff all the time. So I'm still having a really hard time figuring out who this would make the most sense for.
Yeah. Okay. I'm making a case. Here's devil's advocate approach. Ready? Okay. Here's the utopian perfect scenario. If you got the same exact interest rate, let me walk you through this really quick. You got the same exact interest rate. That's a big if, right? So you save. So we're going to say 6%, right? 30 or 50. So you go with the 50. So you save $366 a month. That is $4,092 a year. Rabih, do you know where I'm going with this?
You invest it in the market.
Let's imagine you are disciplined and you're going to optimize this on the spreadsheet like Rabih, and you are going to say, okay, I'm going to take that $4,392 every single year. Oh, 92. I put 92. And I'm going to invest that. And I'm going to do a globally diversified portfolio. You know what? I'm going to go to Dentist Advisors. I'm going to make sure that Rabih is managing my money. And we're going to get a 10% rate of return for the next 30 years. I'm going to do it just on the 30 year, right? Because we'd normalize it for that mortgage. After 30 years, $4,392 every single year at a 10% rate of return would put you at $722,000 So $722,000 at the end of that 30-year period. Utopian, you are so disciplined, you're going to take that savings and not go spend it on something else, like an 84-month car loan. you're going to go invest that money. In that case, if you're just trying to optimize, you would say the difference there would be about over $200,000 difference in your favor.
Yeah, but I think this is an argument in favor of renting at that point, because if you're
Yeah.
going to do that same exact thing,
Agreed.
go rent, it's going to be much cheaper and be properly disciplined.
Yep.
And you'll probably save like $500-$600, and that will turn into $1 million in 30 years.
100%. And I actually misspoke. I'm an idiot. This doesn't even still make the case. Even if you were optimizing, you're still spending $1 million in interest. So you're actually still short $300,000. So what am I talking about?
Don't pay interest, people.
Don't
pay interest.
So no, there is no case. I even tried, guys. I did my best. We tried. It doesn't make sense. So we're saying nay on 50-year mortgages. Is there any other case?
I'm trying my best to see the good in that thing, but I can't.
Yeah, banks will love it. I can tell you.
Yeah, buy a
Banks?
50-year mortgage-backed security. Here we go.
Yeah.
Do that instead. So yeah.
Yeah, there you go. Okay, there is no case. You're still ending up short. Well, more to come on this. If someone wants to make a case of a 50-year, then we're all ears. But it doesn't seem to make much sense. Last thing I'll mention on this, Ben Carlson wrote an article on this that he made a case that I thought was super interesting. And Rabih, I want to actually get your response to this. Same thing we've talked about, which is, Rabih, you said it perfectly. This is a attempt to fix the demand side as opposed to the supply side, and this is a supply issue. He made a case for what if, for first-time home buyers, we gave them an initial rate for any first-time home buyer, gave them a 3% mortgage rate if it was a first-time home purchase. And so he breaks this down just really quick. If you gave them a 3% rate using $500,000, 6% versus 3% 30-year mortgage, now they're saving almost $900 on their payment, and they're paying $320,000 less in interest. Now, there's a lot of factors here we need to discuss of like what this would do to the market.
100%.
But Rabih, I want to, or Sean, both of you, he called the same thing what we did, which is the 50-year mortgage. He referred to it as a Band-Aid on a machete wound, which I kind of loved. It's not solving anything. He's suggesting, what if we gave a 3% mortgage to first-time home buyers? Thoughts? Does that solve the problem?
Yeah, if we restrict this conversation on how do we improve demand, not solve the housing crisis we have in this country, but how do we improve demand, you can rank different policies according to their effectiveness. A 50-year mortgage is effective. It's dropping your payment by a certain dollar amount. Lowering or fixing in the mortgage rate for first-time home buyers is also an effective mechanism. It might not really drop the payment much below because you're still on a 30-year, but it really and significantly drops the total interest paid across the lifetime of that loan. So those are two different policies that incentivize demand, and probably in Ben Carlson's case, because there's still more money left in the pocket of the home buyer, it's a better policy than the first one, than the 50-year mortgage. If we zoom out, and this is what you said, Matt, and we look at the market and the impact that does on the market, because it's a more efficient demand tool policy, everyone's going to go flood and buy a house. That will increase house prices. That will make the payment even more expensive. And it kind of cancels out. So the problem is
fix
with
the
supply.
issue.
The
It's
problem
supply.
is with supply.
Yeah.
Don't give me a 50-year mortgage. Don't lower my interest rate, but incentivize home builders so we have so many more new units that we can kind of have a stable price growth year over year. We target inflation in the whole economy as a whole. We want a 2% economy as a whole. Why don't we target inflation in each certain industry or sub-industry? Housing, grocery, etc. I know they fluctuate, but let's target a 2 or 3% growth in real estate by controlling supply and demand.
Yeah. Sean, any thoughts on that?
Yeah, I think, if there was something that just targeted first-time home buyers, competitive rate, I think that'd be great. But yeah, it doesn't really solve the supply issue and would further decentivize people to then move after they're locked into that 3% for their, first time for in their first home. And so I think it would just kind of put a further, limit on supply, because then nobody's going to want to move.
Yeah, and I think you could argue that it would actually have the opposite effect of it would raise the floor even more of home prices, because these first-time home prices that have already now gone, and I think the median home price in America now is over $400,000. That goes even higher because people who could afford with a down payment, even if they get a 3% mortgage, those prices go even higher for that first time home. Like, it probably just prices everyone out of first time homes in general, like, period. You kind of like, I think that could be the result. There's more to this. I think there's other things to be doing here. Rabih, I think you said one, incentivizing home builders somehow, some way. This is above our pay grade. Here's another thought. How about we restrict large asset managers from being able to buy first or single family homes? Like, truly, there needs to be maybe something done there, so you don't have the biggest asset managers in the world managing billions or trillions of dollars being able to buy up all these homes and mess with supply. So just a thought, maybe, again, above our pay grade. Any other thoughts on the home front? No? Rabih, do you like my solutions? Possibly. Okay, this will be a quick one, and then we'll wrap up. The question being, is it time to start collecting pennies? We just wanted to reference, you may have heard, after 230 years, which is kind of crazy, 230 years that the penny has been in production. It was introduced in 1793. Back then, just so you guys know, a penny could buy a biscuit, candle, or a piece of candy. Now they're, as we all know, what are you doing with a penny? Literally nothing. They just kind of pile up in jars. So I didn't know this either. I kind of, it makes sense, but it costs 4 cents to make every penny. And so they are officially out of production. According to the U.S. Mint in Philadelphia, this is going to save taxpayers $56 million a year by not. But yeah, which is a rounding error. But still, that's like Rabih's portfolio this year, plus, give or take.
Yes, my portfolio is pennies.
Yes. So coins are now officially, or the pennies officially out of production. My mind immediately goes to, these go the way of Labubus or Beanie Babies or whatever else you want to call it, of becoming collector's items. I'm looking forward to the next several years of just kind of seeing the secondary market for pennies, especially the ones going back. I think it was like in the early 80s, they used to make them with actual copper. And now there's like zinc and other things. But I just wonder what secondary market is created with pennies. Any thoughts on this, guys? This is kind of just a fun one.
Yeah, actually, I think the secondary market already exists and is thriving. You go to Reddit and you see all those currency and paper note enthusiasts, and they look at the serial number, they look if there's a misprint, if it's centered, not centered, and they pay quite the amounts for them. And I'm like, yeah, this is just like any other collectible. I dare put it next to crypto in the same type of investment class.
Okay, I'm going to start collecting pennies. Sean, are you going to be collecting pennies?
I think my kids have enough of a penny collection in their piggy banks, so I think we're probably good on that. But one thing that's interesting is, if you know Topps, the trading card company, so they just released a penny trading card just the other day. So it has a picture of the penny on the front, 2025, and then it has the year 1793 to 2025. And it says U.S. penny, U.S. Mint discontinues coin after 232 years. So not only is a penny itself a collectible, but Topps has made a collectible trading card of the collectible.
Yeah.
That you can go and buy right now.
Yeah.
So that was kind of funny.
If you've got pennies in your drawer, maybe save them, and they'll become collector's items. Who knows? We'll probably hear news stories in the future of someone who found some like crazy old penny that ends up being worth all this money. So kind of interesting. Okay. Any other final thoughts, guys? We'll hit contribution limits next week just to wrap this up. But any other thoughts you guys have? Any other words of wisdom? Okay. Well, if you're still here listening, you're one of the cool ones. We want to hit again. I keep meaning to do this at the beginning of the show, guys. Michelle, I'm so sorry. But we want to talk about Launchpad really quick. This is our 12-week live program where we're doing classes covering everything from cash flow management, debt, investing, taught by who, Rabih Damachki. We're going to be bringing in outside experts like Dr. Daniel Crosby and some other experts in the space to talk about even navigating your career as an associate and, behavioral management on the investing side. So it's going to be amazing. We're releasing this beginning of 2026. The goal is to teach you everything you did not learn about money in dental school. If you want to know more or sign up for the wait list to get notified when this is officially being released, you can go to dentistadvisors.com/launchpad. Launchpad. We'd love to have you there. Okay, guys, for now, everyone, thanks for listening. Sean and Rabih, thanks for sharing your words of wisdom. That was our 2 cents. Till next time, have a good weekend. Bye-bye.